Hello, I'm Billy Gridley, your moderator for today's live stream series 2020 digital program. I'm a director on the Investor Network team at Ceres. Ceres is a sustainability nonprofit organization working with the most influential investors and companies on the greatest sustainability challenges of our time, including the climate crisis, deforestation, water pollution and scarcity, and inequitable workplaces. Before we begin today's program, I would like to share our heartfelt sympathy for the family and friends of George Floyd. Ceres stands in strong solidarity with the Black community and the peaceful protesters who are challenging systemic racism. As an organization dedicated to building a just and sustainable future, we at Ceres realize that eliminating racial injustice is crucial to the kind of future that we seek. Our hearts also go out to everyone affected by the ongoing effects of the global COVID-19 pandemic. We are especially grateful to those who are working so hard on the front lines as they help us to keep safe and healthy. At Ceres and in the community of investors, we look forward to working with all stakeholders, companies, policymakers, investors, communities, to ensure that we build back better from COVID-19 and that we support a climate-smart economic recovery. The focus of today's session is how sustainable ESG investors who dig deep are critical to the work to build this just and sustainable future. Before we start, I want to thank personally our speakers, Michelle Dunstan, David Hochstim, Matt Gershon, and their organizations for participating in today's program. Finally, we would like to highlight and say how much we appreciate the generous commitment and support of our sponsors, without whom this program would not be possible. Thank you. Before we begin today's session on deep ESG investing, I have a few housekeeping notes. First, please note the session is being recorded. We will be providing a copy right after the session. Next, if you have any questions, please enter them into the chat box that is located on your control panel on the right side of your screen. We will do our best to answer as many questions as possible toward the end of the session. Finally, please note that there is a potential that due to global bandwidth issues, we may experience some challenges. Unfortunately, this is largely beyond our control, but if it does happen, we will pause the discussion for 30 minutes to allow the bandwidth to readjust. We want to thank you ahead of time for your patience in the event of such an issue. Now, it's my pleasure to welcome our panel. Michelle Dunstan, Global Head of Responsible Investing, AllianceBernstein. David Hochstim, Director, Senior Research Analyst, ClearBridge Investments. And finally, Matt Gershon, Director of Research at Parnassus Investment. Welcome to our session on deep ESG investing. I'll try and set the table a little bit for the discussion. What do we mean by deep ESG? Environmental, social, and governance investing combines a traditional approach with other valuable and material inputs derived from ESG metrics, and most importantly, ESG thinking. The term ESG was coined in 2004 in a UN report titled, "Who Cares? Wins: Connecting Financial Markets to a Changing World." We are in a rapidly changing world with big systemic challenges. COVID-19, climate change, racial injustice, and social inequality. Square on the table today is a fundamental question: how together can we drive better and more resilient outcomes, both investment and real, for people and planet? At Ceres, we believe that rational investors who integrate dimensional and beyond financial research into their investment processes and into their organizations will likely be in the best position to succeed. Many investors now consider ESG metrics. Others are learning how to actually integrate ESG into the entire investment process. Leading the industry today are investment practitioners like the ones on this panel, who think deeply about ESG, who persistently dig deep into companies, communities, and Earth systems, and the interdependencies between them. At the vanguard of the cutting edge, who are constructing climate risk-ready portfolios and thereby accelerating the world's transition to a net zero emissions economy. All of these investors at different speeds believe that better outcomes can result from pushing the boundaries of a conscious sustainability worldview. For 30 years, Ceres has been at the forefront of mainstreaming sustainability. When people think about ESG, they think about Ceres. From our original Ceres principles of responsible investing to our seminal Ceres investor blueprint, to our Ceres 2020 company roadmap, and now to the work of the Ceres Accelerator for Sustainable Capital Markets. We run cutting-edge networks, deep rivers of thought, leadership, and advocacy. That's why, after a long career in Wall Street, that's why I'm at Ceres. Today, we will hear from 3 leading practitioners at 3 leading investment organizations. And I'll repeat their names. It's Michelle Dunstan, David Huxton, and Matt Gershon. All 3 are active equity fund managers. All 3 are thinkers, leading their organizations and the investment industry in new, deep ESG directions. So I'll pose 3 questions. Each panelist will speak to each question for around 3 minutes, and there may be a little follow-up question from me. And then we will take questions from the audience. So my first question, and it's going to be to Michelle, and then David, and then Matt, is about your organization and culture, I guess. The question is as follows: how has your organization integrated a deep, dimensional mindset of ESG into both its culture and investment processes? How do you educate your staff? How do you allow them to push the boundaries of sustainable investing in new and deeper directions? Michelle.
Thanks, Billy. So thanks for the introduction, and thank you for saying those words at the beginning. I think all of us here deeply agree, and those words really resonate with us too. In terms of integration, I think it needs to start from the top. At AB, responsibility is an active pursuit that unites all parts of our firm, whether it's the way we work, our community service, or the way in which we do investment. If we, as asset managers are asking companies to evolve and change, then our own practices need to mirror those. So we're continually examining our own practices and trying to evolve and improve. This helps to ingrain responsibility in our culture and have it permeate throughout the organization. In terms of the actual integration, we've purposefully chosen an investor-driven model for ESG. Our analysts and PMs are at the heart of the process. Too often, we've seen ESG teams operate in parallel to the portfolio teams, conducting their own analysis on companies, and then trying to tell the portfolio managers and portfolio teams not to invest in a company because it's bad or because a carbon price would lower its IRR by 4%. Often that never truly gets integrated, even though there's really good analysis and research going on. Investors, analysts, and portfolio managers are the best positioned to actually do this. They know their companies and sectors really well and which issues are the most material for them. They're in the best position to quantify and integrate the impact of those issues in their company earnings, cash flows, or credit models. The analysts and PMs are the ones that have to own and embrace that investment decision. And lastly, when it comes to engagement, it's much more powerful if you have the decision makers, the people who are going to decide whether or not to buy that stock, talking to the company managements and the boards. That way, the people at the company know that the decision makers actually care about this. It's going into their analysis, it's going into their investment, and you're much more likely to drive behavioral change in the companies. But to do that, you actually need to train and equip your analysts with information, knowledge, and tools to be able to actually do this. So we do have an ESG analyst team. What they are subject matter experts. They're there to support the analysts when they're doing their analysis. Do you have a question about if and how a carbon tax might be applied in a particular jurisdiction? Our Director of Environmental Research can help you. If you have a question on analyzing a company's supply chain for forced or unethical labor, what do their practices and policies look like? Should there be improvements? How do you engage with their head of their supply chain on this? Our Director of Social Research helps them out and conducts the engagement with them. We've also built a range of proprietary tool sets. Our eSite and PRISM platforms are research tools that allow analysts to share in real time information on ESG research, on engagements, document it, follow it up, and drive towards outcome influenced decision-making and outcome influenced engagements. Training is critical. So for 2020 alone, we're offering 5 different modules to our analysts that span the range from let's see, executive compensation, best practices of corporate governance, modern slavery, and most critically, we are sending everyone of our investors to climate school in 2020. So we have collaborated with the Lamont Doherty Earth Institute at Columbia University to design a climate change curriculum. We think this is an incredibly important issue for all analysts to understand. These issues are increasingly becoming more and more material to companies in every sector around the world. And we're relatively long-term looking. A lot of our analysts are looking 3, 5, even 10 years out. Knowing what's going to happen and the impacts on that are crucial to making the best possible investment decisions with the best outcomes for our clients. So our curriculum focuses on the science of climate change, focuses on a little bit on the public policy, the legal frameworks, how that's evolving, and most importantly, it focuses on finance. How do you think about the impact of climate change on securities, on revenues, on costs, on cash flows? So we're now deepening our relationship with Columbia to broaden it beyond that. But these are all things that we're trying to do to ensure that analysts and portfolio managers are at the core and that we have an ecosystem of tools, of knowledge, and of people that support that.
Thank you, Michelle. I appreciate it very much. So, David, the DNA, the education, the mindset, the culture at ClearBridge, which is a great investment company.
Sure. Thank you. First, thank you for including us in this session and for inviting me. I guess I'd first start off saying that I'm an industry analyst, focus on financials. I have a partner who splits coverage with me. And what's different at ClearBridge is that ESG is really integrated firm-wide. And any one of my research colleagues could have spoken on this panel just as I am. ESG is included in each analyst's process for researching companies at ClearBridge. And so we don't have a separate ESG team that's done comprised of non-financial analysts, or use, as some firms do, an overlay of third-party research. So we're looking at companies, we as industry analysts and and sector experts. We have, and as long-term investors, we have access to managements and the ability to engage regularly with senior managements at companies we look at and own. And so we have the capacity to discuss and engage with them on important issues. And so internally, when we generate investment ideas and construct portfolios, ESG analysis is central to that. It's already integrated into the research performed by analysts. And that's not just analysts like me who work in central research, but also analysts that work on individual portfolio teams dedicated to different portfolios as well. And so we think that this integrated approach results in a thorough and detailed evaluation of companies' risks and opportunities, and allows us to think about the specific issues that relate to those companies individually. And when we look at companies, both analysts and portfolio managers engage and discuss these issues, examine the ESG issues that are relevant to each company's business activities, and we think about them and the impact they have both qualitative and quantitatively, and we often suggest ways for companies to improve their ESG practices. We think it makes a lot of sense to have analysts who are industry experts perform this ESG analysis. Some ESG issues are common across companies, such as corporate governance or perhaps labor management, but others, such as environmental efficiency or supply chain responsibility, may not be. And then there are others that are very sector specific, such as drug pricing for pharmaceutical companies, or in my sector, responsible lending practices, for example, for banks. Those don't really apply to other industry sectors. So for every stock in our coverage, we have buy and sell recommendations and investment theses supported by our valuation and ESG analysis. I think I'm happy to have follow-up questions, but that's sort of in a nutshell what I think this team.
Thank you so much. I'm going to turn to Matt and ask, of course, the same question.
Great.
Matthew.
All right. Again, similar to the other panelists, thank you, Billy, Ceres, for having Parnassus come. Our story at Parnassus has a lot of similarities to what you heard from my co-panelists, some differences as well. The most important thing to think about with Parnassus is that the firm was founded in 1984, and it's really been in our DNA since inception to be exclusively an ESG focused investment company. When we started out back then, our founder, Jerome Dodson, with the mandate of being ESG, the style of investing was incredibly out of favor. ESG was something that people thought would take away from returns overall and wouldn't be additive in any way. We've ridden the waves from our initial seed capital of $300,000 up to where we are today, over 30 billion, by making sure that we understood that you could do great ESG work and make a great investment firm. And one of the things that we think about is having a workplace that embodies everything we expect out of the companies that we're investing in. So we have an amazingly productive diversity and inclusion committee. We have a really generous 2-to-1 matching for donations that we do as employees. We have amazing resources in forms of benefits across the board. And we try to practice what we preach, and I think we do a very good job at it. Turnover at our firm is incredibly low. With regard to the structure of the research team, as director of research, the ESG mandate falls in my lap. In one way, we're similar to some of my peers here in that we're all ESG analysts, but we're a little different in that we also have ESG experts. So we have both of those things happening. And the ESG experts are there to help the fundamental analyst figure out an issue or add color or give, frankly, a recommendation on the stocks, but they're also very much focused on engagements with our companies to make sure that we're able to affect change and be part of the positive, virtuous business cycle. And the education really starts, frankly, from the time that people are an intern at Parnassus, and every single member of our equity team was an intern at Parnassus. And when you come in and you do your work, you get educated in our process, which includes our focus on quality investments, which frankly has 4 main components, which are mode management, relevancy, and ESG. So fully integrated from the moment you started Parnassus to hopefully the time you leave as well, but we haven't had much of turnover, I think, as a credit to our workplace. As DOR, the way I keep up on top of the ESG issues, a lot of members of our team are participating in all sorts of industry-wide working groups and some of the big name organizations that you've heard of. We actually work with the third-party databases to give them feedback. We are a company that believes in continuous improvement, so we have semi-annual offsite meetings that always have a dedicated ESG only session, which helps us to improve when we implement those changes in the weeks and months after those days. Our ESG teams and specialists are fully integrated into our sector teams, so they're always offering opinions. And the fundamental team works in conjunction with those specialists as well to make sure we extract the most ESG information we can from a company, and then turn around and try to get more information from all of our portfolio companies. So in summary, it's really part of what we've been doing for the last 35 years. And at the same time, given the evolution of the space, we're always learning and always evolving. So we're going to continue to look for best practices in this area to, embed and communicate and affect change.
Thank you very much. I appreciate all 3 answers, and that was really the question on culture and ESG mindset. My second question goes to these times specifically. They're unusual, they're challenging. There are systemic interconnected shocks occurring right now, health, social, economic from COVID, and other sources. And on a daily basis, there are new truths and insights being thrust upon all of us and markets. So in your area of expertise, how are you thinking differently? I mean, literally in the last few months, what new or old material ESG issues are you paying more attention to, upping your research or teamwork? What's new in this environment in terms of material ESG issues? And I go to David, please, first.
Thank you. So ClearBridge's ESG mission for over 30 years has been to integrate our ESG analysis into fundamental research and portfolio construction, and use our engagements with companies and proxy voting to drive positive change. And I'd say that the fact that we have low employee turnover and we're long-term holders means that we have very good access to management teams. They want to hear what we think, and that engagement, I think, has the potential for positive change, and we've seen that. So the positive changes we've helped and worked towards are promotion of economic equality that supports social equality, as well as responsible environmental and governance practices of companies that we own and deal with. And so the ways that companies can better support their employees and the communities in which they operate, and while still operating successfully, are the kinds of things we've been talking to companies about more even since the coronavirus pandemic started. And so an example in my space would be the kinds of relief that financial institutions are providing for customers, helping them work through the difficult period. And it's interesting because what we've seen is that banks and other lenders have been very willing to work and eager to work with customers to help them gain access to excess liquidity. And many borrowers, consumers, and even some corporations took advantage of forbearance programs early on in March and really in late March. And over the last 2 months, many of those customers have been repaying those have basically been choosing not to roll forward those forbearance programs, and many have been making payments. There's certainly stress in the environment, and many customers and consumers and small businesses are struggling, but I think it's impressive to see that financial institutions have been working with them because they recognize we're all in this together, and a strong economy depends on success for everyone. So I think that we're seeing clear evidence that companies increasingly recognize that supporting the advancement of everyone's right to live in a safe and respectful and just society is really a key element in the sustainability of any business and our society, really. And so I think the other thing that we looked at is how higher quality companies have been taking extraordinary efforts or additional efforts to care for their employees, to help them with health concerns, providing additional healthcare benefits during the pandemic. The most successful companies have had very smooth transitions to remote working, and that's reflecting investments they've made in the past few years in technology and basically working closely with employees. I think it's also interesting that many of the best companies have basically said there will be no layoffs. And we've been very pleased with that. No layoffs during the pandemic to protect jobs, and it's an example of something that's good for all stakeholders. It's very good for employees. Employees don't have to be anxious that they may lose their job. That allows them to do a much better job of supporting and helping customers, and ultimately that's good for shareholders. I think it's also interesting to see how companies have been preparing for the world after lockdowns, and that's we're seeing there changes in the way customers are being served and supported, again relying on employees. They're critically important, and taking care of employees allows them to do a much better job taking care of customers. And I'd say one of the things that's kind of...
We're getting a little tight on time. I'm going to move to Matt. I'm sorry to interrupt.
All right, I can follow up later. There's a lot to talk about.
Absolutely, there's so much to talk about. This is so much happening. Matt, new and old material ESG issue. New?
Okay, so there's a great question. There's a lot going on right now, and we are, as all investors would acknowledge, in very uncharted waters. Up until January, very few people had really even heard of COVID-19 or had really thought much about coronaviruses in general. Yet, and here we are several months later, and went through a period where most, in this country at least, non-essential businesses were closed. I mean, we can only hope for a quick recovery, but frankly, at this point, it's going to be about the slope of the recovery, and it's a very difficult to predict pace. So what does that mean? What are we trying to do here? Really, our ESG team has had a number of engagements lined up for 2020 that had to be postponed due to COVID-19. These topics including physical and transition risk, digital human rights, and exec compensation. Many of the engagements were postponed, but we basically pivoted and started engaging with companies on their response to COVID-19. Prior to the engagements, we signed onto the investor statement on COVID-19. This was a coalition of 22 investors led by Interfaith Coalition on Corporate Responsibility, Domini and New York City's Controller's Office, and that represented over $9 trillion in assets, and it issued a 5-point business plan for protection of workers, and provide paid leave, prioritize health and safety, maintain employment, maintain supplier-customer relationships, and financial prudence in general. And after signing on to this initiative, we drafted a manual on how COVID-19 would impact sectors, and engaged with our companies in 4 phases. Identifying laggards due to limited disclosure on COVID-19 interactions. Number 2, companies in the top 10 holdings of each fund where portfolio managers felt the need to send investor relations or investor statements on COVID-19. And the third one, companies that are typically not so engaged with ESG and are flying under the radar, we really reached out to them. And finally, companies that have done really well with their response to COVID-19, we worked with them as well. So it's been an ongoing process, and there's a lot going on, but really the world is very dynamic now, and I'm sure this understanding that we have today is going to be changing over the next several months. And so it's our job to really just keep on top of this, make sure our companies are doing the right thing.
Thank you, Matt. Michelle.
Yeah, I'd like to echo a lot of what Matt and David said. I think it really is important to conduct deep fundamental research here, and the issues of fundamental and ESG are so intertwined when it comes to social justice and COVID-19 that it's almost impossible to separate them. So if you take COVID-19, for example, we also pivoted and did a lot of engagement with management teams in terms of trying to identify and quantify what the short and potentially long-term impacts of the virus on their businesses were. We also rolled out a series of pretty innovative research tools to better equip the analysts and portfolio managers. So the eSight platform, our tool for research and documentation of ESG engagements, we added COVID-19 to that pretty quickly. And over the course of a couple of months, we are now up to 300 substantial documented engagements with management on those issues. Of those, actually 65% identified specific E, S, or G issues in addition to a fundamental impact. So this isn't just fundamental, it's actually impacting ESG factors also. So in addition, we've built a coronavirus alternative data center. That's our data science team in conjunction with our analysts. And this helps drive, again, better analysis and decisions. So some of these tools track the virus itself, cases, hospitalizations, transmission rates. There's a lot of global activity metrics, whether that's mobility, credit card purchases, factory pollutions, restaurant bookings, or even things like drug tests in the US, which could be an indication that actually employment is ticking up. And then we've mapped company supply chains back 2 or 3 tiers and overlaid those on how is the virus progressing in different regions and countries, and also where there are government mandated shuts. Lastly, we've done a bunch of web scraping from employee review or sentiment sites to measure how well employees are thinking that their company is handling this, whether it's the preparedness from work from home, or how well they think their CEO is behaving, or how well they think their company is treating them. Some of these measures I've mentioned are pretty short term and will abate with the flow of the virus, but I think some of these sentiment metrics are actually longer term. When we exit this, 2 or 3 years down the road, do companies who have treated their employees well and whose employees believe that the management teams are responsive, do they have an easier time at attracting, retaining top talent? So we're going to follow this out long term and see if it has an impact on longer term company performance and stock returns.
Excellent. Thank you so much. So we're going to go to the third question now. The first question involved culture. The second, what's changing in the world, new issues coming up, and thank you. Now, a little bit of focus perhaps on, what companies are succeeding, which ones particular, and is it a function of they themselves, those companies, integrating ESG into their own operations, or not? That's whichever. Matt, if I could start and ask you that question.
It's a good question. It's always difficult to extract what elements of ESG are actually contributing to outperformance or underperformance, but it's something that we work a lot at. Some examples of companies that we've been involved with lately that I think might give some clues as to this. For example, Clorox. In this environment, I think everyone has been looking for Clorox wipes, right? And they've been trying to find sanitizing products. And that's a great story. It shows to the relevancy of the product in this time, and that's wonderful. But it's important to know, like, the company has continued operations, increased pay and benefits, implemented elevated levels of health and safety measures. These are types of things that are happening. So similar to what was mentioned before, we really believe that these types of operations will lead to better engagement with employees and lower hiring costs in the future. So that's an alignment there. We have investments in semi-cap equipment or semi-cap software companies like Synopsys. It's really in a position of structural opportunity that integrating material ESG considerations into its business operations and goals. Its products are very critical in developing silicon chips and are that are more space and energy efficient, and its security products are relevant to cybersecurity, and quality stress testing are crucial in times like this, in automotive, data center, and the cloud. And internally, they're also addressing their own carbon footprint by offsetting 100% of company emissions and working towards setting science-based emission reduction targets. And 80% of its workforce is technical and engineering roles, and almost half have master's or PhD degrees. And the retention rate, it's just it's so integral for these guys to maintain this amazing workforce that they have, and we believe that they're doing the right things, creating the environment that's going to help to retain all those employees over time. As far as just in general, I mean, every company is really being challenged by this pandemic in different ways. And just to close up, I think we're very much focused, as I mentioned in our last segment right there, protecting human capital through continued pay and benefits, increasing health and safety measures. They really are the first, or should be the first, priorities of companies. And suspension of non-essential activities and services is really changing long-term business landscapes. So like FedEx and UPS have suspended service agreements or guarantees. Recycling companies are maybe permanently disrupted. 60 counties and local governments suspending curbside pickup programs. These things are all happening right now, and we've really got to make sure that people are focused on them, as well as climate risk, which is really not a top of mind thing for a lot of companies trying to survive right now, but we want to be there as Parnassus, telling them, remember, remember, remember. Let's make sure that you remember what your obligation is. And so, we're trying to take a role in that as this whole landscape is changing every day.
Thank you, Matt. Appreciate David. Companies, is it responsible banking companies doing well, or?
There are, but I think I'm going to mention two sort of non-traditional financial companies, and not really financial companies, MasterCard and Visa, which I think are doing an excellent job in this environment. They are providing help to, in their core business, they provide help to underserved and unbanked consumers around the world by facilitating financial inclusion. In the pandemic, they are working with governments to help distribute payments to individuals through debit cards, prepaid cards that enable governments to provide that financial assistance that's so critical for certain members of society. And they are companies that have a global footprint and in a good way, that are helping people and societies around the world. Enabling commerce helps boost economies, helping subsistence farmers, for example, more efficiently sell their crops, which is possible because of mobile phone-based payment systems that use Visa and MasterCard's rails. Those are transformational for people who don't live in our society, where many people do have bank accounts, but the people who don't have bank accounts and don't have credit cards or debit cards have been left out, and Visa and MasterCard are working hard to add to the global economic system. So, in the interest of not running out of time, I'll stop, and then I can.
So much. I appreciate Michelle.
Yeah, I think that companies who have been very thoughtful about how they built and integrated their systems with an eye on the future are the ones that are succeeding. And often these companies that are very forward thinking have embraced ESG in the way they designed it. And a lot of times that has put them in an advantaged position to quickly adapt their technology and their operations to work from home, to provide the support to their employee and communities that they need, and still continue to serve customers. So I think there's plenty of examples of companies whose employee management has been good and paid dividends. So take Williams-Sonoma, for example. They have a lot of brick and mortar stores that are closed, but they chose not to furlough or lay off their employees. Their distribution center staff, they continued on with a lot of incremental health precautions and extra pay. What they're seeing now is they're able to fulfill the surge in demand that they've been seeing when their competitors can't. Now that they're starting to reopen those brick and mortar retail stores, they're measuring the employee sentiment, and what they're seeing is an increase in employee engagement and loyalty. So this has really paid dividends for them during this process and has actually translated into pretty strong financial and stock performance. And then I just wanted to mention a very different sort of example, but it really draws on this forward thinking and how a lot of these systems are really integrated. So Enel is a European utility, and it's been on the forefront of planning for an energy transition for a while. So they've thought deeply and broadly about how to live in a low carbon world and invested not only in a renewables business, but a lot of infrastructure, tools, and processes that have served them really well during COVID-19. So solar and wind power are small and dispersed as opposed to a big power plant. So you need a very sophisticated grid management system and IT systems to actually manage that. And also it's intermittent. The sun doesn't shine all the time. So what you also need is real-time customer monitoring and management of demand in order to match those two up. Today, what that means is they've been largely able to operate remotely. So no meter readers, not a lot of people in the switching stations. So they've been able to supply the energy while keep their employees safe at home because of this forward thinking. And if you look at customers, because of their sophistication in looking at energy consumption and billing, they've been able to identify which customers are struggling. They've proactively given those customers a lot of relief. So they've behaved responsibly to their customer base. But what it also does is allows them to better manage their credit risk. So all of these things have kind of worked together. You can see how little bits and pieces that are seemingly unrelated have actually translated into a very good outcome for a company like Enel during this situation.
Excellent. Thanks very much. Before we go to questions, I want to ask, and we have about 4 minutes to answer this very big question, which is you all talked about engagement, each one of you, and I know you're involved either working with companies, working with groups work with companies, and Matt mentioned that we had to change some of the scheduling of those engagements. And is there any break in that logjam right now? Engagement is an essential extension and part of the practice of ESG. You are all three engagers. Is it starting back up? What do you think about that? Very quickly, David.
Yeah, I guess I found that in some ways, remote working means that we're working all the time, and I found that it's possible. Can't have face-to-face engagements, but I found it relatively easy to set up brief telephone or video engagements to address particular issues as they come up. So it varies from company to company, obviously, but I think that companies are in most, and certainly in New York, are working from home, and they're working all the time as well, and so it's possible to communicate.
Thank you. Very quickly, Michelle.
Yeah, I mean, engagement never stopped. I think the nature of it just shifted a little bit. We were about to kick off a proactive campaign on encouraging companies to have ESG metrics and executive comp and carbon targets. That got delayed, but we're actually restarting that now. So I think things have gotten to normal. So I don't actually think the quantity or quality of engagements went down. It was just that rather than trying to push companies about these long-term issues, there were some more pressing immediate needs that analysts and PMs needed to engage on companies with. So I actually don't think it stopped. It just pivoted a little bit to focus on what was a very near-term priority as opposed to the long-term goals.
Appreciate it. Matt.
Absolutely. Like I said, like Michelle said, things just went on pause a little bit as everyone was doing massive amount of triage in March. And the conversations continue. The only thing I'll add, because the other panelists did a good job of addressing this, is I feel strongly, and our team is really experienced, that this virus, as well as all of the social unrest that is happening now, given the problems we have in this country, has created opportunities for us to dialogue with our clients and our companies in a way that maybe even wasn't happening before. They're coming to us, and they always have, for advice on how to implement best practice, but they're really coming to us even more now to have frank discussions about what's happening in the world, and that's creating opportunities for us to have conversations about other things that we want to get done with them over time. So we're excited about the opportunity that's been created by this very unfortunate situation.
Thank you very much. Thank you. We're now going to transition to the question final portion of the session. And a very interesting question has come in, which I'm going to ask first Michelle. And it's actually a very diabolical question, because it's a question about the tragedy of the horizon, which underlies many of the problems associated with thinking about, reacting to, and adapting our investments in society to climate change. And the question is, dramatic change is needed by 20, which requires companies and investors to take action now. How are you thinking about horizon, where that's only a 5 or 10-year horizon to start this transition in the direction that is needed? How is your thinking changing as this 2030 date comes towards you in terms of your investment horizon in your portfolio?
Yeah, that's a really good question. I think, we're a fairly large investment management firm. At the end of last year, we had about $650 billion of assets under management. We have two types of portfolios. Across all our actively managed portfolios, we integrate ESG issues. And then we have a set of what we call portfolios with purpose that have specific ESG goals associated with those. Those are the fastest growing part of our business. And a lot of those are tackling head on some of these issues, not just integrating it, but building a whole product around it. So our sustainable platform deals with this. We have a carbon neutral fund, and we're actually about to launch 2 more carbon neutral funds, a global one and an Asian one, to try and drive further in this direction. We're also leveraging our partnership with Columbia. So we're working with them right now on climate risk scenario analysis. So not just leveraging third-party providers or our own analyst capabilities, but integrating their science into our decision-making and analytical tools to help us move in this direction. The other thing we're thinking about with Columbia, and this is something that is obviously still in discussion, is we're going to try and use some of their data not only in our products, but co-developing products that deal with climate change based on Columbia's science and AB's financial know-how. We are also engaging on this. We're pushing companies towards best practice, whether that's setting carbon targets, other ESG metrics and executive comp. So it's kind of got to be a well-rounded effort. It's not enough just to divest. Only 30% of the world's oil goes into cars. So even if you will move to 100% EVs tomorrow, you still need a lot of oil. Let's engage with these companies and try to get them to do better. That's also a really big impact on society, is not trying to be perfect tomorrow, but drive in the direction of better.
Thank you. Perfect. So I have another question which comes in, and well, you can't have an ESG session without talking about data. And people look at it in different ways. And Matt, this question is for you, which is, you referred to working with the ESG data providers quite actively to help them improve data and understand data, collect more data. I don't know. Maybe you could speak to that, because data about what is happening is the lifeblood of pushing deep ESG further. So I can ask you that question. How are you thinking about data and your efforts to help people get better data?
I think you have to take a step back and think about data, ESG databases in a bit more of a historical context. You started with KLD making Socrates many, many years ago, and it had a lot of information in there, and they were trying to have a master database of everything about companies from an ESG perspective. That's folded into MSCI. We also have Sustainalytics. So thankfully, we have 2 large providers that exists somewhere between sell-side research probably and bond rating agencies. They're a little bit between the two worlds. And frankly, given all the dynamism in this market, we have methodology changes quite frequently at both places. And more importantly, if you try to correlate the two databases and see what's similar with regard to their recommendations and what's not, the correlation is actually quite low for companies that are highest scoring and lowest scoring. So what I want to say, and the reason I started historically, is that 10, 15 years ago, the databases were interesting, right? And we got some information from them before. Today, they're helpful, but they're not something to rely on exclusively. And we're active managers, and the best information that we're going to get is from talking to companies, pushing them to publish sustainability reports with specific guidelines that we give them. And all of us in this industry, all the investors, have a very important role in continuing to push more and more and more for information from these providers that's accurate and can be compared from an apples to apples perspective. Because right now, a company, for example, I'm not going to use names, in MSCI or Sustainalytics would get significantly penalized for not having disclosed something. And could be about employment, could be about a benefit package, and that could ding them completely on a score. At the end of the day, there was a specific example where we spoke with that company at length about this, and they're like, well, we just didn't fill out that part of the database. And so they had a very positive actual policy around this. It takes a lot of effort, takes a lot of resources to actually populate these things, and it's just not efficient, perfectly efficient yet. So I'm very optimistic about the future of ESG data, and the database is improving over time, and they have come a tremendous way. But right now, and I think really, frankly, forever, and this is spoken as an active manager, there's always going to be room for that interaction with the individual companies. We own 40 in my portfolio right now. And we have relationships with all of them, and we can talk to them about ESG information, and we continue to keep doing that, and with the hope that the databases will continue to improve, and we provide information to them as well, saying, oh, you should check in with these guys. I had a call yesterday with a management team that said, oh, you said that our exposure to alcohol sales was at 9.9%. Where did you get that? And we said, well, from this database. And they said, well, that's actually not accurate at all. It was 6 to 7. And it's just like very interesting how the data can be off. But summary is, individual company is the best way to do it, but the databases are certainly helpful for gathering information on businesses.
So what I'm going to say there is that there is return to deep digging and
absolutely
and active research and deep ESG. Yeah, and don't trust the data. Dig yourself.
Absolutely.
Great, thank you. Well, we have got time for one more question in 2 minutes, only for David. Responsible banking, you referred to it, and are you getting the kind of data you need to to judge whether the words of the commitments are matching the reality of the balance sheets? That's a loaded question, sorry.
Yes, it is. I think disclosure varies a lot from company to company, but I do think that one point that bears making is that some of the public information is somewhat misleading about the banks. The banks are seen as big financiers of fossil fuels, and in most cases, and many of the adverse publicity for the industry really reflects the fact that the big banks are larger and have more capital markets activities, and that is very different than the choices they make with their own balance sheet and with their own shareholders' funds. And many of them some of the large banks have basically stopped funding coal, for example. And I think they're struggling with how to balance their own views about climate change and the actions they should take to limit financing, but it's bigger than these companies. There needs to be a holistic government-sanctioned global approach, because if every US bank stops working on financings for companies in oil exploration, for example, there will be other sources of capital from somewhere else that will come and meet that need. We need to have a coordinated approach to recognize the harm that certain activities pose to the planet, and not just try and shift blame to the banks because they're big and they're.
So I think we've just gotten to the subject of our next webinar, and we're going to leave you hanging in suspense, and we're going to have to kind of go and wrap up the session. So thank you so much for participating in today's session on deep ESG. But before we, adjourn, I want to again thank the sponsors that you see on the screen who provided instrumental support for Series 2020 digital program. After this session, you'll receive a follow-up email with a recording of the session. And for those who are following along, there's another Series 2020 session on June 18th. It is Climate Investment Opportunities in Emerging Markets. That's June 18th at 12 p.m. Eastern Daylight Time. To register, just go to series2020.org. There's another session after that, which then concludes this digital program and this huge pivot from a 3-day in-person late March 24th through 27 to a digital program. And we're getting toward the end of the journey, and we have learned many excellent learnings and stories from all our different investors, companies, sponsors, NGOs, research organizations, and for all of this program, we thank you. We thank you very much. And so, with no further ado, this session is adjourned.
Thanks.
Thank you.
Thank you. Thanks, everyone.
Thanks.